Welcome to the Stock Market Palantir. Today, we are going to talk about KOS, so Cosmos Energy, ticker KOS. This has to be the most polarizing name in the independent E&P space right now. What we're watching is just this massive divergence. You have a company with globally significant confirmed assets trading like a distressed microcap. The stock is sitting at about $1.07 a share, just clinging to the low end of its 52-week range. We saw that big 4.5% drop on December 2nd, but it's really the persistent tension that's remarkable. High volume and the dark pool data is showing an off-exchange short volume ratio that's just stuck between 23 and 29% all month.
Right, and that persistent tension, that high OESVR you mentioned, that is exactly why we need to talk about this. It really defines what I'd call the valuation paradox at Cosmos.
I mean, on one hand, you have consensus analyst targets up around $3.64. That implies what? A 200% plus upside from today's $511 million market cap. But the market itself, the price action, is just a flat-out rejection of that potential. So the question is simple. Is the market missing something huge, or is it rationally pricing in a truly existential risk?
Well, my position on this is pretty unequivocal. I believe the market is misjudging the timeline. It's discounting the asset value based on, frankly, temporary anxieties. It's completely fixated on short-term liquidity noise, and it's ignoring the imminent, transformative operational shift that's already underway. We are at a bullish inflection point that the price simply ignores. And that cash flow is coming from the Greater Tortue IMU project, GTA, and it's all shielded by a very robust hedging strategy. I'm calling it the Great Escape Thesis. See, I fundamentally disagree with that framing of an inflection point. The $0.07 valuation isn't a rational anxiety. It is a cold, rational calculation of profound risk. This is the definition of a value trap. The market is pricing in the overwhelming probability of dilution, or, something worse, a full restructuring. The net debt burden is just colossal, $2.9 billion, and the operational ramp-ups have consistently lagged what management promised. That makes the liquidity runway dangerously tight, and I believe equity holders are facing almost certain capital structure adjustments before any of that cash flow you mentioned actually hits the bottom line. This is my dilution spiral thesis.
Okay, so let's detail that escape route, because it's real. KOS is actively pivoting from a speculative explorer to a production-heavy company. We saw it in Q3 2025. Production was up 3% quarter over quarter. But the real game changer is the GTA LNG project. Look, we got first gas, and the first LNG cargo was exported way back in April 2025. That wasn't just a press release. It physically confirmed the underlying value of the asset. And the market seems completely oblivious to the financial defense mechanism they have in place. For 2026, 8.5 million barrels are hedged with a high floor of $66 a barrel. Now think about that. The EIA is forecasting Brent could average as low as $54. So those hedges, they represent a guaranteed $12 per barrel of extra cash flow. That is an essential bridge against any commodity price collapse. It ensures debt service continues.
The hedging program is a point of defense, I'll grant you that, but it's only covering about half their production, and it doesn't solve the core timing issue. The current equity price reflects a profound skepticism that KOS can navigate the liquidity challenges they face before those big 2026 and 2027 debt maturities come due. The reality of late 2025 is that we're in a cash flow trough, right when the company desperately needed a cash flow peak to, satisfy its creditors. The revenue realization, the actual timing of cargo liftings, it's just continually lagged behind all the positive headlines. And that forces investors to aggressively discount any future guidance. When you have $2.9 billion in net debt consuming over 85% of your enterprise value, the equity is just a highly vulnerable residual claim. Every operational flip, every market tremor gets magnified. And that pushes us closer to a mandatory refinancing on really, really punitive terms. I just think the market's assessment of that liquidity risk is overly pessimistic. It fails to adequately model the guaranteed cash flow from those hedges. That $66 floor, it doesn't just stabilize revenue, it dramatically reduces the risk premium on the 2026 notes. And yes, the GTA ramp-up has been slower than hoped, but it is on a defined path. The value proposition here is simple. If the assets produce the forecast cash flows, and achieving first gas proves they can, the company is worth multiples of where it is today. The timeline just has to hold for another, say, 18 months. 18 months is an eternity when you're trading near $1 and debt covenants are biting.
You can talk about asset value, but we have to talk about the integrity of the balance sheet right now.
And that brings us directly to Core Exchange 1, that $250 million senior secured term loan cost took from Shell in Q3 2025. They drew that facility to pay down existing unsecured notes. I mean, logically, using a secured facility, mortgaging your core assets, to pay off general unsecured debt, that is a classic textbook signal of financial distress.
I acknowledge how that can be interpreted. Yes, that securing new debt to retire unsecured debt can signal distress. But in this specific case, I reject that conclusion. I would frame the Shell loan as a strategic move that de-risks the capital structure on two fronts. First, it deals with the immediate 2026 maturity wall. It substitutes that near-term risk with a facility backed by a massive, credible counterparty. Second, and I think this is more important, it solidifies the relationship with Shell Trading, who is a key off-taker for their assets. That gives them a long-term strategic advantage that, in my view, far outweighs the perceived distress signal.
That is a very sophisticated way to reframe what looks like forced financing into a strategic partnership. But partnership or not, the key takeaway is that KOS did not access the traditional unsecured bond market. So why? Because the interest rates demanded by generalist lenders were just too high? Or maybe the market was just closed to them given their debt ratios? The fact that they had to resort to pledging assets for $250 million, it confirms the tight liquidity runway and shows that confidence in their ability to refinance on their own is extremely low. And every dollar of secured debt just pushes that leverage ratio higher and subordinates the equity claim even further.
Okay, but let's quantify the mitigation then. You focus on the security aspect, but you're downplaying the massive credit enhancement from the $66 hedge floor. If oil prices dip to 54 like the EIA warns, that floor generates roughly $102 million in guaranteed cash flow just from the hedge settlement in 2026. You just multiply 8.5 million barrels by that $12 differential. That cash flow is non-negotiable. That guaranteed stream directly services the debt, which makes the need for that punitive refinancing you're worried about less acute. It's effectively a $100 million plus injection that counters the very tightness you perceive.
$100 million is a welcome sum, sure, but it's a drop in the bucket compared to the $2.9 billion net debt pile and the required cash outflow over the next 24 months. If the unhedged barrels, the other 50% of their production, are selling at $54, their overall realized price could be structurally below their corporate break-even, especially when you factor in the cost of that Shell loan and their massive G&A overhead. And the key operational choice they made, it confirms this urgency, the CapEx cut.
Well, that liquidity argument leads us right into the implications of their operational choices. And I believe the market is misinterpreting management's fiscal prudence. Here, we have to focus on the operational successes that improve the future cash flow profile. GTA is operational, and management successfully lowered its CapEx guidance for the year to below $350 million. Cutting CapEx, especially in a high-interest rate environment, is the definition of disciplined cash preservation. It's a prudent move that ensures maximum free cash flow generation once these projects stabilize. That's ultimately what benefits long-term equity holders.
I just find that defense of the CapEx cut totally unconvincing. The market didn't reward it. It viewed it as forced austerity. It was compelled by the need to service debt, which just confirms the liquidity anxieties we've been talking about. It signals that cash is being prioritized for creditors, not for reinvestment, which completely undermines the growth story. To really understand the operational failure, you have to look at the Q3 2025 results. Yes, production was up a little, to about 65,500 BOEP. But that tiny production gain was completely overshadowed by the critical revenue-production mismatch.
Okay, explain that mismatch more clearly.
They missed revenue expectations by nearly 10%. They reported $311.23 million against an expected $345.25 million. This isn't just about volume, it's about the timing of the lifting schedule and actually realizing favorable prices. That huge revenue miss was profoundly more damaging to sentiment than the small production gain was positive.
It strongly suggested the unit economics and the realization timetable were deteriorating, and that just cranks up the pressure on their short-term working capital.
The volatility of a lifting schedule is inherent to the E&P business, especially with international assets in Africa. Basing the destruction of a long-term thesis on a single quarter's noise is, I think it's short-sighted. The foundational value is still there. The cash flow will come. We should be focused on the progress at the assets themselves.
But you can't isolate the massive African developments from their funding mechanism. That's the whole point of their integrated model. When your short-cycle assets, the Gulf of Mexico projects, which were supposed to be the internal ATM providing cash to fund the long-cycle African projects, when they fail, the entire financial architecture comes under stress. The market's reaction to the $51.1 million write-off of the Winterfell 4 well was devastating, precisely because it confirmed that their ATM had broken.
The failure of one appraisal well, while costly, doesn't invalidate the entire Gulf of Mexico portfolio or the African potential. Write-offs are a known risk in this business.
For a company this highly leveraged, a write-off of that size is not just a statistical blip. It forced the market to remove those future reserves and cash flows from their NAV calculations. And in a company where debt is already eating up the vast majority of the enterprise value, any reduction in asset value has this magnified negative effect on the equity. It proved that management's execution risk goes beyond scheduling delays. It touches resource confirmation itself. And this operational uncertainty, combined with that debt clock ticking, is exactly why institutional money is heading for the exits.
Which brings us to market microstructure, which is really what's defining the price floor right now. While our fundamental debate is about asset value versus debt, the trading behavior down here near the lows tells its own story.
And the story it tells is bleak. The dark pool data is the clearest indicator that sophisticated money is leaving. That persistent 25 to 30% off-exchange short volume ratio, it's crucial. This isn't a simple speculative short attack. We are seeing institutional distribution. These are long-only funds, pensions, sophisticated money liquidating broad exposure, selling into weakness through dark pools to minimize their market impact. It strongly suggests they believe a material downward catalyst is coming.
I acknowledge the signal of institutional distribution, but let's look at the implications of that volume being sold short. This creates a highly technical and, I'd argue, dangerous situation for the sellers. The stock is precariously close to that $1 regulatory threshold. If oil prices dip further in Q1 2026, the potential for a reverse stock split becomes very, very real.
The threat of a reverse split isn't just a potential, it's probable if they close below $1 for 30 consecutive trading days. And while it's mathematically neutral, the psychological impact is profound. It historically triggers widespread algorithmic selling. It often signals that management has just capitulated to the market's pessimism. And given KOS's history, they almost got delisted in 2020, the market knows this risk is structurally embedded in the name.
I agree, the reverse split is an anchor, but I think the market is underestimating the volatility trap that's been created by this short positioning. We know short interest is high, 12.59% of the float, but the truly critical metric here is the days to cover ratio. It's currently sitting at 5.4 days.
And why is that metric so important in this context?
Because a ratio over 5 means that if all the shorts tried to cover their positions to buy back the shares they borrowed, it would take them more than 5 full days of average trading volume just to get out. This creates immense risk for them. Any positive catalyst, GTA hitting full capacity faster than expected, an unexpected spike in Brent crude, it could trigger a rapid, violent short squeeze. This whole setup offers a really asymmetric payout for volatility traders who are betting on my great escape scenario. The price is being suppressed by fear, yes, but that suppression is fueling a powerful coil.
That argument relies entirely on an external catalyst. It doesn't address the internal structural deterioration. And if you look at the options market, sure, there's high open interest, but much of that open call interest is likely just stuck money, legacy positions from when the stock was at $3 or $4. It doesn't reflect new, sophisticated bullish bets. The smart money in the options space is focused on hedging downside risk through late 2026 and positioning for continued volatility, yes, but primarily volatility that resolves through a capital event. And the resolution of that conflict is the core of our disagreement. disagreement. My thesis remains anchored in the immense gap between today's $1.07 share price and the confirmed, in-place asset potential of the GTO project. It's a leveraged option. It's a bet on scenario A.
A great escape, where management executes flawlessly and the hedges provide the exact cushion they need to bridge to full, self-funding cash flow. And my position is that the market is already pricing in the high probability that KOS is a leveraged bet on external factors, macro oil prices, credit availability, that are all trending against them. The repeated evidence of delays, the forced capex cuts, the reliance on secured borrowing, it all points to scenario B, the dilution spiral. The reality is that the $2.9 billion debt overhang is so overwhelming that it prevents equity holders from ever realizing the asset's true value unless they get bailed out by a commodity spike. Until they successfully address that 2027 debt wall, or GTA is demonstrably churning out hundreds of millions in free cash flow, the share price will remain anchored by balance sheet risk, not geological opportunity.
So Cosmos Energy is far from a traditional energy investment right now. It represents a highly complex, time-sensitive race between cash flow generation on one hand and the debt maturity schedule on the other. In short term, that $1 level is the critical psychological and regulatory line in the sand.
Indeed, the underlying asset is potentially world-class, but the equity itself is structured in a way that risks near total value destruction if that operational timeline slips by just one more quarter. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.